Okay, so last week we had an illuminating conversation with Bill Stecker, owner of the website 72calc.com, but he is a CPA and an absolute genius when it comes to early retirement strategies and specifically the 72T. Well, we were really getting into the nitty gritty, so we had to continue our conversation with him, right, Bill?
Yeah, I mean, he's a savant. He's a genius. We could talk to him for hours, and we did so even after this episode. It was just plain fun. I never thought talking tax code would be so much fun. So before you listen to this episode, you really got to do yourself a favor and go back to last week's episode, part 1 of Mr. 72T.
I think I did something right. So I didn't realize that the amortization method was like the one that just makes the most sense for most people, because when I was doing it, it allowed me to segregate the smallest amount of money in a separate IRA that would give me the most monthly amount. I was looking for $15,000 a year for 5 years, and using the amortization method, I only had to lock up, I think, $240,000 worth of my IRA. When I found your website, you made that crystal clear. And I'm like, okay, everything he said made so much sense. I wish I would have uncovered this sooner, because I kept bouncing between the methods and it just wasn't clicking. And then you made it crystal clear.
Essentially what you're doing with the 72T plan is saying, aha, it's multi-year, it's minimum 5, could be more to get to age 59 and a half, and you are self-annuitizing distributions. You're your own insurance company in that context.
Right.
Yeah, exactly. And you're covering a gap that you plan on having, just like Jackie did. She's going to have a gap of 5 years till 59 and a half when and so you're basically creating an income floor at some level so that you can make it till everything's out of jail.
Who can make a mistake? First person, me. I'm in the theory business. I'm in the plan design to cause distribution streams to occur. And I'm going to opine to you, essentially a multi-year legal contract that says, I guarantee this plan is right. Define right. No surtaxes, no interest, no penalties. Now, if I make a mistake, and I can be proud to say I've never made one to the best of my knowledge in this arena, that's why I carry errors and omissions insurance.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
We need to talk today about also, there's 3 different methods of calculating your 72T SEP payments, so to speak. Can you go through those and tell us which might be the most popular and the most valid to help us be flexible?
Okay, if you read all of the popular literature, everything will start by telling you there are 3 methods, and they are amortization. Annuitization is number 2, and what's called minimum method is number 3. Now, I will tell you that, well, let's get practical for a moment. Let's pick a method, but let's test it to see if it's of any use. And those tests might be maximizes my distribution dollars per amount of IRA dollars devoted to the plan. I think that's number 1, and for that matter, that's kind of number 2 and number 3 on the list of what makes for a good computational methodology. In that context, the amortization method is the only one that works. Everything else is an also ran. Don't bother. And amortization requires 3 variables. We talked about it before. An account balance, a life expectancy, and an interest rate. And the math is the PMT function in Excel, and it is, for all intents and purposes, it is the same math that your banker uses today to compute your mortgage payment.
Yep.
And the annuitization, if you want to know why it fails, I've got a couple page write-up about from some actuaries that tells you why it fails. It just always gives you a smaller number. Minimum method fails because, again, for two reasons. One, the minimum method doesn't use an interest rate. So guess what? You put the same factors in amortization, put 0 in the interest rate, and you get the minimum method number. And so you'd say to yourself, well, gee, I have $800,000 in my IRA. I would like $50,000 a year, because that's what the amortization formula tells you. And then you jump over to the minimum method, and it says, well, you could have 25,000. Don't you just kind of go, no, I'm not interested. I know what the literature says. The reality is it's amortization.
Thank you for that. So I think I did something right. So I didn't realize that the amortization method was like the one that just makes the most sense for most people, because when I was doing it, it allowed me to segregate the smallest amount of money in a separate IRA that would give me the most monthly amount. I was looking for $15,000 a year for 5 years, and using the amortization method, I only had to lock up, I think, $240,000 worth of my IRA. When I found your website, you made that crystal clear. And I'm like, okay, everything he said made so much sense. I wish I would have uncovered this sooner, because I kept bouncing between the methods and it just wasn't clicking. And then you made it crystal clear. So you need to choose the method. Okay. What are the other pieces? You mentioned the other pieces of information. Can you sort of list out the other 2 or 3 pieces of information that you need in order to do the calculation? And you do have a calculator on your website, by the way. That's very helpful.
Well, are you talking about the operands and the math?
Well, so you got a great calculator that does all of that. But before someone starts to say, let me figure this out, what other pieces of information, like you mentioned an interest rate, what are the other, I guess, pieces of information?
Obviously, getting an account balance is easy. More often than not, you look it up online and boom, there it is. The second piece of information is an interest rate. And what the IRS tells us is you can use up to, so this is going to be a ceiling, 120% of the midterm applicable federal rates from either the 2 months preceding the month of the first distribution. What a mouthful.
I know.
It's awful. But it's kind of a two-edged sword here. It's easy to look up federal rates. They're all over the place on the internet. And you can actually look at the monthly revenue rulings coming out from irs.gov to say, and it's right there in the chart. For example, the current rate is 5.43%, which will be, you can first use in March of 2025. Okay? So you got to go grab that rate first. Now, in the latest revenue notice, which came out in 2022, the IRS actually gave us also a floor rate for the first time, which is 5%, which means even if the midterm applicable federal rates are all in the 4s and lower, which they had been for a decade of the, say, 2010 to 2020, you just use 5%. So you got a floor at 5%, and it's at the moment growing higher. Now, what's the April rate, the May rate, June rate going to be? I don't have a clue. I stopped guessing long ago, but it's probably going to be in that range. And the amortization formula is sensitive to that interest rate. You can go to my calculator. You can use, like I say, the PMT function in Excel. You'll get radically different distribution amounts as you change the interest rate.
So what's interesting to me here, and we talk about the 4% rule being a safe withdrawal rate, and you're talking about 5%, and portfolio construction within your IRA from which you take your distributions according to the SEP rule becomes important too, right?
Yeah, well, there's a couple things at work here. Whole bunches of well-learned mathematicians, way smarter than me, have figured out this safe withdrawal rate question, and they seem to coalesce in the neighborhood of 4 to 5%. And so what is a safe withdrawal rate? Safe withdrawal rate is theoretically meant to be that amount indexed for inflation over usually 30 years to basically solve the question or the dilemma: how do I ensure that I go prone with $5 left, as opposed to being vertical and broke in terms of a distribution stream? That's a totally different, to which, by the way, I subscribe. Whether you listen to Bill Bengen, who you had on earlier, or whether you read the Trinity study from the late 1990s, you get all of those same kinds of answers. Conversely, here we're just wrestling with a 5-year tax issue. And so even though you might have $800,000 in your IRA today, and my math says you can take $50K, which is about 6.2%, I think that's okay, because all we're talking about is 5 years. We're not talking about 30 or 40 years.
That's the critical difference, so people understand they're not going to deplete their portfolio.
Oh, right.
Right. They can segregate it, right?
Well, also, new sources of income are going to start kicking in, such as you might be lucky enough that you've got a defined benefit pension that might be kicking in, or you're in a public service function that still might have a pension. Social Security. Social Security will still be there. Take it to the bank. Now, when can you start receiving full benefits? That we already know that guy's moving. Aren't we at 66 years and 10 months old?
67 now, I think.
I don't know when it goes to 67. It either just did or just will.
Yeah, I think if anyone hits it like 2025, maybe 2026, it catches everybody at that point where it's now 67. And you're right, it will change. The way it looks will likely change, or the year that you can take it. However, Social Security is going to be there in some form or fashion.
Absolutely.
So basically, there is a higher, quote unquote, safe withdrawal rate because we're time limited generally.
Yes.
You can stretch your time out 10 years, though, and you got to be a little bit more careful, I would imagine, because people would be worried they don't want to deplete their SEP portfolio.
Yeah.
And as a tangible example, Jackie, are you willing to share with us what you did in order to create this plan and what you invested in and how you came to your number?
Yeah, so I started out, and again, I did have some brokerage money that kind of ran out, and I didn't want to use it all. And I was starting to use my Roth contributions, and I'm like, okay, I should want my Roth account to grow more, right? Because when I take that money out, it's tax free. So I'm like, why am I doing this? Let me go ahead and do a 72T. So I had just turned 55 at the time I decided to do this, but I was thinking about doing it for years, ever since I retired. Okay, so the amount that I needed, because I didn't want too much coming out, because I do get subsidies for my health insurance and things like that, because I'm on the ACA. And so the amount I came up with was $15,000 a year. Okay. That's how much I wanted. So I backed into it. So I used, as Mr. 72T was saying, I used that number, plugged it into a calculator. And Bill, maybe you can clarify this. I used the amortization method, as you suggest. I believe I had to put in my age and something about my life expectancy. I had to check that table. So I put that number in there, and it came up with roughly $240,000. Now, I had already had, and Bill, I got a bunch of different IRAs. So I already had an IRA that was roughly that. So I used that IRA. It was Schwab. And I called up Schwab because somebody had told me they had to fill out this form and they had to go in person. You don't have to do all that. So I did all my stuff online, and I called Schwab expecting to get someone that has no idea what a 72T is, but he did know. And he was very helpful. And really, at that point, I already did all the hard stuff, as you were explaining. I did the planning, I ran the numbers, and all I needed from him was, how do I set up these equally annual withdrawals? I wanted to set it up annually. You could set it up monthly if you want to. So basically, it's an online form. You do it like you do any other withdrawal. And I said, it was almost like automating this whole thing as far as the payments go. So I said, every December 1st, I want $15,000 or whatever that exact number was paid out to me into this account. And I was done.
Right. Actually, you just touched on 3 new issues.
Okay. Oh, gosh.
One is, I remember I said you have to pick a life expectancy.
Correct. And I did. I had to pick
There's
that.
3 permissible life expectancies. There's what's called single. If you're married, you can also use joint and several.
Okay.
And you can also use what is called uniform, which is nothing. It's uniform life expectancy is identical to joint and several life expectancies with an assumption that your surviving spouse is 10 years younger.
Okay. So I'm single. I'm married. So I went with the single.
Right. Now, of those 3 numbers, we have to go back in history. If we look back to last century, quote unquote, the wild, wild west days of 72T plans, ask 5 actuaries for a life expectancy table and you would get 9 answers.
Another confusing thing.
They were all over the place. Finally, in 2002, the IRS said, enough of this nonsense. 1 table. And then, which is the single table. And then the JS and the uniform tables are simply derivative tables. Yeah. And it's always the single table that gives you the smallest number, which in that math formula gives you the biggest annual distribution.
So a lot of this stuff with the 72T have become a lot easier. I remember right after I retired, when I was looking at this stuff, it was overwhelming to me. And then as time went on, I said, well, let me revisit. And then there was these changes that you have already talked about that just made it less intimidating. So I'm hoping that if anyone has considered this or is considering this, give it another look between this episode, your guide that you offer for free on your website. It makes it much easier. There's calculators out there. You've got one on your website. Dinkytown.net has a great one. And there's a couple other ones. So Bill, Yount, to your answer to your question, that's how I did mine. And I felt much better doing it, especially after I found this 72T Calc website and the guide. I had all kinds of crazy questions and he answered every single one of them. So it was good. Okay, Bill, what you got?
So Mr. 72T, you mentioned 2 more things that she brought up.
The next 2. One is, just so people are aware, it's a sidelight really. When you start these distributions, some financial institution is going to issue you a document. It's called a 1099-R. The R stands for retirement distributions. And they will only issue 1 1099-R per distributions per IRA. So you talked earlier about taking money once a year versus once a quarter versus once a month. The Internal Revenue Service has no purview to look at your transactional history within or on an intra-year basis. They can't. That's why Schwab, in your case, Fidelity for somebody else, issues 1 document per year, which is the sum of all distributions from the IRA. How you actually distribute is your business and your business only.
So you're saying, so I could go in and I could switch my automatic withdrawals to monthly or quarterly as long as it still equals that exact annual amount?
That is correct.
Okay.
I won't necessarily recommend it, but what you just said is true. The third issue I want to bring up is, in every case, you got a financial institution, usually a biggie, and you think that they are your trustee and your custodian, and they are. And you think, well, what trustee duties does my trustee owe me? And the answer is, wait a minute, stop the bus, back up 3 stops. They're a bank. First banker's rule, keep the money. Second banker's rule, protect all of myself and my money. meaning they take a blind eye to your 72T plans. They don't care that it is a substantial eco-periodic payment or that you're doing it from the separation service at age 55 or age 50 because I used to work for the NYPD. They don't care. They say to themselves, we know your name, we know your address, we know your date of birth, and we know your account balance, and we know you took bucks out. Therefore, I'm going to give you a 1099-R. That's the law. Now, it's your job as the taxpayer to complete what's called Form 5329. It's another, pardon me, busy IRS form, but you got to do it, which basically says, yeah, I took an early distribution, and here's my reasons, because it can be more than one, for having taken the distribution, and it is a qualified reason, so the 10% surtax plus interest does not apply. IRS, listen to me, don't listen to my trustee. He was not doing me any favors.
Yeah, that's really important. And just to stress your point, I have made other withdrawals, like from my Roth IRA.
Sure.
It's the same exact form, and I have to tell them what was my reason. And my reason was I am taking out the contribution portion.
Correct.
Which they ask me, how much is your total IRAs? How much did you take out so far? To determine, oh, yes, she is actually still taking out the contribution portion. I get the same, and I already got my form. I get the same exact form, except the reason for that is different. And you're right. It's a question between me as a taxpayer and my taxes and the IRS, not necessarily the custodian. If anything, they want to be held harmless, I'm sure.
Yeah, well, they do not want to be ever accused of being in the tax advice business. That's the whole issue.
So it brings up a couple of points, and we're going to have to talk in a minute about mistakes you can make. But for me, it's smart that Jackie does it on September 1st and in one payment. That's probably the easiest way to do it, because remember that your custodian can dilly-dally and take time to issue the payment. And if you do it after December 20th, you could get screwed with a mistake where it ends up being issued in the first part of January. And then totaling up all your things, if you do it monthly, you've got to make sure that it's exact and within $1, as you say in your book. But a couple of questions here for me. Jackie, what do you invest in? And the reason I ask is because say you deplete this thing before 5 years, what happens then?
Okay, well, I guess I need Mr. 72T to answer that question. So if I deplete it before 5 years or before I turn 59 and a half, what happens?
Okay. Well, there's good news and there's bad news. The bad news is 4 years ago, you started with $500,000. And 48 months later, the account balance is zero. That's bad news. Because you weren't particularly adept at what investment choices you made.
Right.
The good news is that even though you have violated the later of 5 years and age 59 and a half, the IRS is playing Mr. Nice and has basically said, if you completely drain an account, your account ends and you owe nothing additional.
Hey, Jackie, have you ever wished that you had a financial advisor on speed dial and ready to guide you through every money decision? Someone who could help you optimize your finances, reduce your taxes, and ensure you're always on the right track? Well, with Boldin Financial Planner, that's exactly what you get, right at your fingertips.
Boldin isn't just another financial tool. From creating a detailed retirement plan to exploring Roth conversions, Boldin provides expert-level insights tailored specifically to your situation. It's designed to help you make smarter choices without the hefty price tag of traditional financial advice.
Yeah, Boldin goes beyond just crunching the numbers. It acts as your partner in planning. It helps you navigate critical decisions like how to pay down debt, how to structure your retirement withdrawals, and how to manage your investments efficiently. With its powerful what-if scenario planning, Boldin lets you test different strategies and see the impact of your choices before you make them.
And you know what the best part is, Bill? Boldin is always there for you. As life changes, whether it's a job, a big purchase, or unexpected expenses, your Boldin plan can adjust in real time, ensuring that you stay on track no matter what.
Yeah, this tool is fantastic. It takes an investment of your time, but it pays dividends. With Boldin, you don't just get a financial plan, you get a decision-making partner and control over your financial future. Start playing smarter today at goboldin.com/catching up. That's go.boldin, BOLDIN.com/catching up. Say, for example, you invest in 100% VUG.
He was going to say that.
Just as an example, and maybe Jackie's willing to divulge.
I will.
If she did something like that, and it has a 50% crash, and then you've still got these payments you got to make, and it's not going to recover in necessarily 5 years, that becomes an issue, I would imagine. And then secondarily, second question, I'm violating the podcast rule law, is what happens to the money or the plan after your 5 years? Can it revert back to a traditional IRA based on the plan you make?
Let me try and answer that. One of the privileges you retain, and this kicks off in year 2 of a distribution plan, is that in any subsequent year during the plan window, you can switch from amortization, which relatively speaking gave you big distribution dollars, to the minimum method. And when you do it, you choose to do it once. It's a one-way street. You cannot reverse, and you pick a new life expectancy. So let's say you started with $500,000. You made a bad investment choice. It blew up on you, and you only got $200K left. Well, you're facing two issues. One is, how much can I still distribute? But I think the broader question is, how do I rearrange my life? And more than likely, maybe you go back to work in some fashion. And so you pick the method change to RM to minimum, you pick a new life expectancy, and where you were distributing 50 grand becomes 15, 18, 20 grand.
And you might go to a different allocation in your portfolio that it's not going to be subject to another major drawdown.
You would think so. But obviously, the tax code is not going to give you any guidance nor rules on how you invest your IRA. But yes, you hold this RMD conversion in your back pocket, and it becomes a valuable planning tool once you have multiple IRAs. And furthermore, maybe even, let's say you're 51 or 52, and you're looking at an 8-year plan. You could easily have bumps and dips that you even know about that are going to be coming up in your revenue streams. And so we're going to strategically use RMD conversions at years 4 and 7, so to speak.
I had never heard of an RMD conversion inside of a SEP plan. We're starting, to illuminate the complexity of things here, and you've got to reverse engineer this and really have a reverse engineered plan, knowing all the variables. And I, for one, would say, no, Jackie did it all on her own. She's just that kind of DIY person. I'm the guy that would do it, but I would have it double checked for the errors that we're going to talk about. Before we get to the errors, what did you invest in, Jackie?
All right, look, he's...
I think I know the answer here.
So Mr. 72T, he's already outing me because he knows my go-to index fund, which again, I'm not making any recommendations for anyone else, but this is what works for me. My go-to stock index fund is VUG. That is a Vanguard growth fund of domestic stocks. Okay. So the way that I did it is I don't want to have to switch. So I kept that in mind as I'm putting together my allocation. So even though I do VUG, it is not 100% VUG. And again, the amount that I locked up into this 72T is only $240,000. Okay. My investable assets is right at $2 million. So first of all, this is only 10% of my investable assets.
Alone?
Right. So this has got to last me. So I have to do this strategically. I have a brother, Charles, that gets a regular pension. And I'm like, look, your company set up your pension. I have to create my own pension. Right. Mm-hmm. So anyway, so I have VUG, but it is not 100% in VUG in that account. Okay. So I'm very mindful to, one, make sure that I have the liquid cash available when my distributions need to come out. I don't want them selling anything for me. I want to manage that. So I have my goal is to keep at least 2 years worth of distributions in cash. So anything else is in VUG. Now, next year, I want to probably say, okay, let me go ahead and clip off this, especially if the market's doing good. That's a good time to reallocate and say, let me put a little bit, had a good year, let me put a little bit more towards cash. But my goal is to have 2 years. Now, first of all, my plan is only for 5 years, right? So that makes a difference. But my goal is to have it all invested in VUG with the exception of the fixed amount. I can't even remember if I have it in a money market fund with Schwab or whatever, but it's fixed. It's not in the stock market. That's ready to come out in December. Right now, we're the first part of 2025. And I've already got the money that I need for the end of 2025 and the next year.
And 26.
Yeah, and 26. So I've already got it set up with the intention to always make sure I have enough liquid funds to be able to come out, but the rest is being invested. So if I had to, I guess, do the math, it would be roughly 80 to 90% is in VUG, mm-hmm. and the rest is liquid or in a money market type fixed income. I don't have any bonds in there. However, many people might want to do that. But again, everybody's allocation is going to be different. But the problem you have to solve for is to make sure you have enough cash to be able to take the distributions when you are required to do so.
Oh, that's a very good example. And I appreciate your transparency. I mean, for me, being more conservative, if I was to do a 5-year plan, I would probably have all 5-year distributions in cash. With that, the return there wouldn't be that much different.
Right.
Honestly, it's sort of splitting hairs, but then you've secured yourself. And you've got a lot of growth on the other end. That begs the second question. You've got a 5-year plan. What happens to that IRA at the end of 5 years?
Mr. 72T, I'm done, right? Like I'm not bound to taking out those distributions anymore.
That is effectively, yes. A plan, we know its beginning date. It's the date of your first distribution. Mm-hmm. We know its ending date. We can compute it in advance. It's either the day you turn 59 and a half or it's 5 years from beginning date. So we know the end date. Day after the end date, plan is done.
So what's interesting here is it sounds like what you're creating is a pre-retirement MYGA, which you would create maybe at 70 or 60, lasting 10 years.
Well, what is a MYGA, first of all? Okay, our listener, I think I know what you're talking about. Can you please clarify what a MYGA is, Bill? We got a CPA here, so maybe he knows what a MYGA is.
You're basically paying an insurance company, and it's a form of annuity.
Technically, I guess I have not heard that.
Okay, it's a multi-year guaranteed annuity with a fixed interest rate.
Except you pay a fee.
An insurance company GIC contract. Yeah.
Okay, there you go.
One and the same.
In a way, it's the same thing, except you're doing it earlier.
Yes. I mean, leave it to the insurance industry to come out with acronyms that you need a visit from an insurance salesman to explain to you.
Right.
There's something only to the Internal Revenue Service.
The only difference is, in some ways, you're paying a fee for that, so it's going to cost you more than a 72T SEP plan would. I'm just trying to think outside of the box.
Essentially, what you're doing with a 72T plan is saying, it's multi-year, it's minimum 5, could be more to get to age 59 and a half, and you are self-annuitizing distributions. You're your own insurance company in that context.
Right.
Yeah, exactly. And you're covering a gap that you plan on having, just like Jackie did. She's going to have a gap of 5 years till 59 and a half when and so you're basically creating an income floor at some level
Yes.
so that you can make it to till everything's out of jail.
Yes.
Yeah. And so, Bill, the reason why I don't like acronyms is just because it just confuses people. So I just try to put a little clarity around exactly what you're talking about. That's an insurance product that guarantees you an annual income. So that's what you're talking about. The MYGA, some people may not know what that term is. I barely know what the term is. We got a CPA that barely knows what it is. So now you know what a MYGA is.
I'm not a CPA. I'm not a CFP.
But you know what a MYGA is. We need a MYGA.
And we're going to have an episode on annuities too.
Yeah.
I want to hear about the mistakes you can make. Don't you, Jackie?
Oh, God, I believe I might be in the hot seat. But yeah, Mr. 72T, let's talk about the mistakes. And I pray that I didn't make any of them, but let's go.
Okay. Let's start with who can make a mistake? First person, me. I'm in the theory business. I'm in the plan, design, to cause distribution streams to occur. And I'm going to opine to you, essentially a multi-year legal contract that says, I guarantee this plan is right. Define right. No surtaxes, no interest, no penalties. Now, if I make a mistake, and I can be proud to say I've never made one to the best of my knowledge in this arena, that's why I carry errors and omissions insurance. And in fact, were I to drop dead tomorrow, that's why my errors and omissions insurance has a 5-year tail on it that basically extends my coverage into the future years, even though I'm personally absent. But technically speaking, can a professional make a mistake? Of course they can. You don't want them to, but it happens. Who's the second party that can make a mistake? How about your trustee? We're going to leave you for last. You can tell your trustee to do something, and they don't do it, or they do it wrong, or they don't do it in a timely manner, or for whatever reason. Their computer system hiccups and makes a mistake. The IRS marches in and says, we don't care. Your trustee is your subcontractor. You're responsible for their mistakes. That's not necessarily a true statement, but that's where they start. So again, I mentioned earlier, not only are we in the planning business, we're in the mistake avoidance business. So how do we avoid mistakes from our trustee? We do things like keep a year or two, or maybe even all 5 years in cash, so it's always right there to be distributed. Second way we avoid trustee mistakes, we don't make 12 distributions a year. We make one. Now, whether that one is in January or June or September, I don't have any opinion, but you make one distribution a year from, let's say, the IRA account into an after-tax brokerage account. Then, let's say you want $15,000 a year, which is that $1,250 a month? I'd have to calculate.
It's about that.
And then you say, okay, but my life lives month to month in terms of paying my bills. That's cool. Every month, just transfer $1,250 from the after-tax brokerage account into your family expense operating account. You only made the trustee responsible to do one thing one day.
Jackie, can you automate that?
Yeah, I automated mine. So every single year on the same date. Now I have to remember to stop the automatic withdrawals after 5 years. But yes, I automated mine, which Mr. 72T, which I think is helpful in avoiding one of those possible mistakes, which is not taking the distribution that you're supposed to. Right. I automated it.
The number 3, and this is actually, believe it or not, I've faced this one multiple times. It's a biggie. Never wait till the last 2 weeks of December to instruct your trustee to do anything, much less make an annual distribution. The reason being, Half of the whole entire financial industry of the planet goes on vacation the last 2 weeks of the year because of the holidays. More importantly, they're still open. So who got stuck in the office answering the phone? It's the 24-year-old, 1-year pup who hasn't finished all of his required educational courses. And you're on the phone with him saying, I want you to do this. He's going, I'll get it done. And you're going, oh, you don't want to be there. This is my point.
I might have made this mistake, but let me ask you, since I set up automatic payments, does that maybe give me a better chance of it just automatically being generated? Because when I initially did it, it was on the 23rd of December and I had it by December 24th. So I did the online web form, and the guy that I was on the phone with, he says it's always quicker and easier to do it via the web form and to make it automatic. So I think I did make that one of the mistakes that you're now mentioning, like the last 2 weeks of the year, because mine is the 23rd of December. So I'm hoping I won't run into an issue, but I have it on my calendar as well, like a few days after that, to say, let me make sure it's in there. But hoping that, do you think the automation is helpful in minimizing that issue?
I don't, because it's easier to take a different road. It's easier to make one distribution somewhere in the first quarter and just say, yeah, I'm done for the year, and worry about monthly cash flows separately as a non-cash event and a non-tax and SEP plan event, because you're always asking the question when you distribute monthly from a deferred account. The first question you always have to be asking is, do I have free cash equal to or greater than the amount of the distribution logged into the automated system?
So it won't automatically sell your investable assets in order to do this?
It will not.
Okay, will it just say, sorry, we can't distribute because you don't have enough cash? Is that sort of the message you would get?
Each of those systems are different. I can only speak to one or two who will remain unnamed. Some will just say, I am distributing nothing because I was told to distribute X bucks and X bucks of free cash aren't there. The next system will say, well, I've been told to distribute X, but there's only Y. They're $1,500 short. I'll distribute everything I got. And then the next system will do that as well, but it won't inform you that it shorted you.
Right. So I think I'm going to look into changing my annual distribution to like.
We're teaching the teacher, baby.
I think I'm going to do that. I just have to be careful to make sure that the other automatic distributions is erased, which normally that's pretty easy to do.
Yes.
I'll probably see what's in there and maybe I can click edit or change, and I can change it to April, because, having it on December 23rd apparently is not a good idea.
It sounds like you want to create your 72T in the first quarter, have your payment come out in the first quarter, and probably have 5 years of cash in there. So you don't even need to think about selling investments in order to meet your cash requirements.
Well, can I say something about that? So, Bill, our friend Eric Cooper, he set up a 72T, and I was chatting with him back and forth, and he said he was kind of looking at more towards the end of the year for the first year that you set it up, because you don't know how your income is going to run. So that was part of the reason why I was waiting to the end. I'm sure he didn't mean the end of December. He's like, well, be careful, because like for me, I don't have a regular income. And if I happen to get a nice big chunk from a project that I work on, not from doing this podcast, but for other stuff. But I don't get nothing for this podcast. But let's say if I had a chunk of money to come in, I wouldn't want to do that at the beginning of the year. And I may only be able to assess that towards the end of the year. So that's a tricky thing, trying to choose the right time of the year. You don't want to do it too late.
That's just like your Roth conversion in the final quarter, but maybe the beginning of the last quarter. So we're getting into the weeds here. I want to know too, Mr. 72T, are there any other big mistakes that we can make? Because we learn from the mistakes. And I want to make sure Jackie gets this right.
Well, the third person, we didn't talk about the third party who can make a mistake, and that's the taxpayer.
Yeah.
I didn't say you made a mistake.
I see you wagging your finger at me.
But I spend a couple pages on, I call them do's and don'ts, rules of the road of distribution plans. First rule, early in the year, take care of everything. Second rule, one transaction per IRA. Third rule is really an avoidance one. Some people in the planning process, we decide it's a good idea to have multiple plans running. And it's an easy jump to say, oh, it doesn't matter which IRA I take the distributions from. It's an enormous issue. You must keep the one-to-one correspondence of distribution to IRA balance working. Never take all distributions from one or two or crisscross, because those are modifications.
Tell us about what a modification is, because that's important. That's where these mistakes lie. And then we need to talk about the penalties if you make a modification.
Okay. A modification, believe it or not, is not defined in the Internal Revenue Code. It just says, if you do modify, bad things are going to happen. What's a modification? Intentionally stopping distributions is obvious, or even missing a quarterly or annual distribution, both of which I have seen happen, is a modification, whether it's intentional or accidental, stuff that slipped over from between Christmas and New Year's and doesn't get processed until January 3rd of the next year. That's a modification. So big bucks that were supposed to be distributed weren't, or bucks that weren't were distributed, are all modifications. I suppose the next technical question is, well, how small can the difference be that it's not a modification? To which I give you a two-part answer. First part, don't go there. Second part, $25. I don't think anybody is interested, including the Internal Revenue Service, of penalizing taxpayers for what is tantamount to or close to rounding errors. But anything above that becomes suspect to being, quote, a modification. And the answer is real simple. Don't go there.
Right. So on the point of modifications, I wanted to clarify this because, again, keying in on your practical, sensible stuff that you should be doing. I know that technically using a 401k versus an IRA, should we stay away from trying to use a 401k to do these 72?
Well, obviously, unless you're using exception number 5, which is the separation of service at age 55. Let's put that one aside. Right. I would always transfer from the plan 401k. How about a 403b? How about a 401a?
Through a savings plan.
The list of plans just goes on forever. Get it all into an IRA first. The reason being is you have just removed yourself from being beneath the employer-sponsor umbrella. And number 2, this is a two-parter, when you go to one of the big guys, they all sell the same products, all 10,000 of them. Basically, there's a great big table in the sky, and they all have the same table and a little check mark next to it saying, can this transaction be purchased by an IRA account? Yes or no? And they will only let you purchase eligible investments. And if it's not eligible, you can't have it. It's an on or off switch. And it creates a much broader universe of investment opportunities to you. Now, some people can think of that as an advantage. Other people look at it and go, oh my God, how do I pick? It's a burden. So
food for thought. Yeah.
But then there's some versions of those exceptions that can't use the IRA, so you have to pay attention to that column as well. This is a fascinating topic because it gets into so many different nuances, but they're powerful. This is a powerful tool that Jackie used and that you can use to establish goals of getting to 59 and a half or a little bit beyond. But if you stick to what we've talked about today, it becomes easy. I think this has been a comprehensive deep dive into 72T, in particular, exception for the SEP rules. What do you think, Jackie?
Absolutely. And I knew we had to have the right person to have this discussion. So I wasn't even willing to engage in it without having someone like Mr. 72T here, Bill Stecker, because he's done so many. His whole business is around early withdrawals and 72Ts. He's written private letter rulings and things like that. He has written this guide and that he's offering absolutely free on his website. And the title of it is the keyword is practical guide to substantially equal periodic payments and the IRS code 72T. He's on the 5th edition of that. So this guy knows his stuff when it comes to setting up a 72T. I actually did it myself. He was probably one of the best resources. He answered all of my questions, and he's done this for so many other people. So, Bill, we appreciate you having this source on your website. Now, we talked about this, so I want to make sure our audience understands. So you have a place to put in your email in order to get the guide. And typically, people use it as a lead magnet, marketing, or whatever. You're not using it for that reason at all. So you collect the email addresses for what reason?
Well, I collect your name and your email, just arguably for I suppose, my own personal interest of how many people are getting copies of the guide. I make a promise I would never sell or reuse in any fashion anyone's name or email. You get the guide. And my third issue is I view myself as a gatekeeper. It's my job, not yours, to keep track of, honestly, what Congress and the Internal Revenue Service are up to. And so that when they make a change, either in an IRS pronouncement or Congress adds another couple paragraphs to Code Section 72T, one, I know about it. Two, I can let you know. And I can also, in certain cases, offer my opinion as to whether they've done something good or stubbed their toe.
Well, that begs an interesting question. For the future, in order to flex this plan as a lever, what would you like to see? What would you want Congress to do?
To be blunt about it, remove Code Section 72T in its entirety. Just get rid of it. I believe it to be government overwatch, almost bordering on inappropriate. I mean, there's a school of thinking to which I do subscribe, which basically says this money in this IRA account or Roth IRA or 401k or 403b, I don't care where it is. It's my money. It's not yours. I'm fully vested, so there's no forfeiture. And if it's mine, and did you offer me an advantage in earlier decades by not taxing the gains in those earlier 20s, 30s, 40s, whatever time period? Yeah, you did. And so are you due your just due when I start making withdrawals? Is it appropriate that it be treated as ordinary income? Yeah, I'm willing to accede that. I'm not asking for a gift, but I'm also asking that you recognize this money is mine. It was always mine. It was never yours. And that when I decide to withdraw it, I write you a tax check. End of conversation.
I love it. I absolutely love it.
If that puts me out of business, I'm happy.
Well, I've never heard this comment before. I think you're absolutely right. They hold us hostage till 59 and a half, except for these exception rules, which are complicated and sometimes difficult to navigate. Why not get rid of the rule? But they might be promoting early retirement. There would be less workforce. It might run the economy a little differently. There might be less return or less GDP. And so I completely agree with you. For the FIRE movement, that would be awesome for the people that get it right. Yeah. And for the people that need the money sooner because they burn out and they can't do this or in that capacity with this particular job anymore. It would be ultimate flexibility, just like, Jackie, when we had the HSA episode, we said everybody should have access to an HSA.
Mm-hmm.
Yeah.
Yeah. Yeah. So you're saying we wish there was no need for the 72T, and let's just open it up to say there is no 10% penalty for early withdrawal. Or even if they wanted to split the baby and say, okay, come up with an earlier number, because I hate that they're trying to ration you in the beginning, saying you can't start to 59 and a half, but wait a minute, we're going to make you take it after 75 or whatever that number is. So I hate let me tell you what to do and when to do it.
Most people don't remember, but that's the way it used to be. We got IRAs and 401k plans of varying versions from the late 70s through 1985. And the real issue was back then, they were no big deal. How could you have $1 million IRA in 1980? It was a mathematical impossibility. And so back in the late 70s, early 80s, all of these deferred defined contribution account types were, like I said, no big deal, no big bucks involved. I'm sorry to report, the last number I saw, this was a $22 trillion issue. And so it's not until 1986 we get the Tax Reform Act of 1986, which is the first enactment of Code Section 72T, which says, I'm going to surtax you, because it started becoming important. It was just going up that curve of how many bucks are involved. And Congress said, I want some.
Yeah.
Sorry for deviating from the practicalities of 72T plans to maybe my political persuasions, which is what they are. But like I said, I'm in this land every day. And I'll say it this way, I'd be happy if I was out of business.
Yeah, that is a great way to end it. You are so great at what you do. I'm so glad that I found you and you didn't think I was a stalker, but you responded and we talked quite a bit before we got you on. So, Bill, we've had a history lesson. Okay. Yeah. We've had a math and financial lesson, and we had a retirement and tax strategy lesson in this whole episode. So I know you've helped a lot of people. This was with an expert that knows what he's doing, a CPA that's been practicing for 4 decades at least, that is providing so much free stuff on his website, which is 72tcalc.com. I'll put it in the show notes. And he gives away this free book that's now in its 5th edition to allow you to go through everything. There were some nuanced questions that I had. It answered those questions when I was finding it nowhere else. So, Bill Stecker, where can people find you if they want to connect with you, find out more? We've got your website, but is there any other way people can contact you if they wanted to? Sure.
You've mentioned the website multiple times. Thank you for that. Have your pencil ready? You want to give me a call? My phone number is area code 312-361-0221. That is a downtown Chicago phone number, but guess what? It rings in Colorado. So
you got 2 different residents.
I will always answer my business line.
What is the name of your business?
The name of my business is also my email, which is The Marble Group, just like it sounds, THE, marble like the stone, group, at, and I use a mountain ISP provider because we don't have cable up here, because it's kind of hard to dig trenches through rocks. And they're called Whispertel, WISP as in Peter, ERTEL.net. They are the mountain internet service provider of note for Montana, Wyoming, Utah, Colorado, Arizona, New Mexico, etc.
So, Jackie, we're coming up on 2 hours. Anybody that has made it through these 2 hours is now a 72T expert.
They are. And I will put all of your contact information in the show notes, because you won't find them on social media or anything like that.
No, I don't. I'm too old for that. I'm sorry.
Oh, don't say that.
Well, remember, this is Bill's first podcast.
Yes.
And he did exceptional.
I think he has done an outstanding job. I hope this is not his last podcast. I want his website to spike in people that are curious, see his email list grow, because learning about the 72T, you learn about how to plan your life and how to have a backstop on accessing money that is yours. And we heard it here first. Blow it up.
Yeah.
Blow up 72T so that we have access to our money. I love it. I love everything about this episode. I was wondering where this was going to go because I thought it was a weeds issue. But this is a much bigger issue. And I thank you, Bill, for joining us today on Catching Up to 5.
Absolutely my pleasure. And I hope that a number of your listeners, viewers, get a knowledge base out of this, to at least be able to understand that knowledge is power. And so whatever decisions I make become better decisions the more knowledge I've got.
Well said. And we will catch you next time on Catching Up to 5. So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our social media maven is Diana Falk, and our editor is Fritz Brazard. We love them, and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchingupto5.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to 5. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to 5. Cheers.